the final exam is a couple of weeks away. You want to start getting ready. So some students get really confused in this exam. I don't know why. To me, it seems really, really straightforward. So you have two essay questions. Some students like, is it three or is it two or is it 17? It's how many is it? Two essay questions. All right. The first one is on diversification and does it work? You have a podcast. So what I'm thinking about doing, I've never done this before. We'll see. So because of AI, it can't be it can't be open book, but I will allow, I'll either give you a rubric or I'll let students create their own notes, but with limited number of words, kind of your own outline. We'll see. Y'all might give me feedback on which you read. It's a little more complicated for me because everybody has their own page. But if I get a rubric, it's going to be essentially this rubric. The history, we talked about familiarity versus diversification. We're getting a little bit of that from Ryan today. We're talking about how you know stocks and how you get into stocks. And then we broke it up between the security level and the asset class level. I was much more confident it works at the security level, although it does have its problems, especially in a crisis, than at the asset class level. And then what are those alternative approaches we talked about, environments and options. So that's essentially the question. Some students really bomb on my essays. I read their essays and it looks like they put maybe 30 minutes into it because they thought it was a multiple choice question. So, I'll see it and I'll be recognize it, but it's not. It's an essay. It's the way we learn. We don't learn with multiple choice. So you've got to learn it. If I were you, I would have read the blog. I would have then listened to the class lecture on it. I would go back, look at the notes, and then try to write, make sure I have something on each one. If I'm giving a rubric, that somewhat helps. I don't have to remember the organization, but I would make sure I have pretty solid stuff under each one. I might write out an answer and show it to the professor and say, I'm on the right track, because I won't tell you do this to get an A. I'll certainly say that is really weak. You're going to lose a lot of points right there. At least help you out on that. My goal is not for you to do well on an exam. I want you to be successful, but not successful because I gave you an A, because what is an A for me worth 20 years from now? Absolutely nothing. So what's valuable out of college? It's not what you learn, it's what you retain. So my goal is that you retain it. Do you think Ryan retained anything from college? Pretty smart guy, right? And he did. He was into this stuff and he's really learning it. I remember when I forget the guy's name, just but when he was here, he didn't want to go to college because he thought it was like there's just too much going through the motions. But he says, I'm going to go to college. I'm going to learn this stuff. And that was my attitude in college. It was like I was scared to death though. It was like I better learn this. I better learn everything. Even my art history class, I better learn it just in case I need it. But fear doesn't seem to motivate anyone. But if I were you, I'd be scared of that. I better learn everything extremely well. I'd be learning it detailed. Everything I talk about in my class, I use in my career. I think you're still going to be using it in your career. If you spend an extra 4 hours to learn it really well and you don't need it in your career, then 20 years from now, give me a call. If I'm still alive, I'll give you a $500 reimbursement for that extra time. Who knows? Maybe we can future value it. But should you err on the side of spending a few extra hours on actually learning something, or saving that time so you can do a few more games on your phone, which is more valuable to your life? Finance is still paying you for it. I was really surprised when Luke asked how has the industry changed. AI never came up with his answer. It was there's too many people in this business. We're all doing the same thing. You better have an edge. Your edge could be AI, but you better know stuff. You better know it really deeply. That was my strength at USAA. Again, because of fear, I just learned that company backwards and forwards. Every second I got to learn something new, I took it. I think some college students just think nothing we do in college is valuable. I'll learn it when I get out. You've got to be really careful of that, because if you're not diligent and not doing it here, what makes you think you're going to suddenly change on a job and become a radically different person? I would start practicing now. I do know the students that do extremely well in my classes do extremely well in their careers. I'm not saying people who don't do in my class don't figure it out in their careers and do really well, but I think I'm 100% students that do extremely well in my classes do extremely well, because it's a very similar discipline. It's very different than studying for a multiple choice. I can't think anything in your career that feels like preparing for a multiple choice exam. nothing, but writing papers, doing projects, that kind of thing. So you've got to get, so you can do that stuff. If it seems intimidating, that's all the better, because if it's easy, they're not going to pay you anything to do it. That's my biggest gripe with finance is we give you all the hard stuff and ask you to calculate the easy stuff. And then what happens when you get your job? They don't give you anything. You better know how to come up with the hard stuff. So that's why in Investment Society on Wednesdays, we value stocks. Like we're going to value, I forgot the name of the firm, the steel company. We're going to value it on Wednesday. We might value Sony on Wednesday. How do you value stock from scratch with nothing in front of you? We're going to do that. Brendan's done it the last few weeks. It's easy for him now, but it's still not easy, right? It's pretty tough. So learn this stuff. I think this is really, really valuable. It's just like the essay question on the first exam, which I love so much. It has everything in finance in one question. That's why I love it so much. If you understand that answer or that question, you understand finance because it's all in there. Some students are just shocked that, man, he wants me to know it really, really well. And yeah, because that's what makes you successful. It's not because I'm a mean person. It's because that's what drives success. That's what's going to help you in an interview. So y'all are tired of my preaching, but still learn the stuff. This is a really important one. Does diversification work? I just told you diversification is the #1 risk tool in finance. You better have a good opinion on whether it works or not, because it's going to be the #1 thing they're going to use. So you've got the blog, you've got the class lecture, and then I'll give you some type of rubric. Y'all can kind of give me feedback if you want me to give you the rubric or you want to come up with your own, or both, or whatever that is. I'm not going to let you like write out your entire answer, so you're not going to get 1,000 words, but you might get 100 words on a page for your exam. And guess what kind of cheat notes you get for the math problem? 0, right? What's my world on math? That is finance, or those formulas. You just got to know that stuff. That correlation formula, that is, or that risk formula, that is like every finance major knows that. I know that's not true. I know probably only 10% probably know it, but every finance major should know that formula just right really, really quick. Second question is, it looks like 2 essays, right? Can anybody tell that it's not 2 essays? Is any word highlighted in there that might help you that it's not 2 essay questions? I have students coming in thinking they got to answer both questions. So yeah, I get emails. How many of the essays we answer on #2? How many do you think it is? I would guess it's 1 of them. So you pick one of these. We're going to do the case studies first. We've already done the great thinkers. So you have that. Again, on this one, I'll probably let you do like 100 words or something on a page, an outline. We'll see. I'll test it and see how many words you can get to kind of help you with. And then how many case studies do you need to write about? Any guesses on that? 1. Yeah, it might be 1. Or how many great thinkers in finance do you think you may have to talk about? Might be 1. All right. So you notice 1 is capitalized. I could even go further and bold it and underline it, but so there's the second one. You got the credit analysis, which is a really easy question. You can go back watch the video on that. You have examples on that in YouTube to watch. That's a pretty easy question. It does have a small essay part to it, but you don't get any notes on that. And then the value at risk problem, which you probably have completely forgotten, but probably is the most important thing on this exam, because that formula is so important and is the way we think about this. We just heard Ryan talking about it. He's a market neutral fund manager, long short. He's got to get a beta at 0. He's doing very similar type of math as you're seeing here. He's using, he's looking at the famous French model, looking at what he's exposed to on large cap, small cap, value, growth. He's doing stuff that he got in college. He didn't forget about it. He actually uses it. So I liked what he said about the CFA exam, even though he didn't completely finish it because he didn't really need it, but he got through part 2. As I know people take the CFA exam to pass it, and what a waste of time. I took the CFA exam because it was new material, new information. Part 2 especially, I learned tremendous amount on part 2. It was really valuable. So this is stuff you should know. You get a problem like this, you want to be able to sit down and say, I know exactly what to do with this problem, because you'll see these problems in work. These are not uncommon types of problems you see in finance all the time. All right. The problem here is the problem I'm going to give you is going to be slightly different. However, question 1 and 2 will be exactly like you saw in the example problems. It's only that third question where I'll throw maybe a little bit of, and I'm running out of curveballs to throw because there's not too much I can do there. It might be historical VAR, it might be parametric VAR kind of thing, or something to kind of say, is this distribution normal? Is it got some skewing to it? So you'll have to, you've got several examples because we've worked several problems already. All right, any questions on the final? Unfortunately, this final is so unusual. It's usually the week after the last week of class. This one, last day is May 5th, and the final is May 7th. I don't know why it got moved up. It's usually used to be like the next week, like on Tuesday or Wednesday. I don't know why they changed the final schedule. So we'll probably, the last class will be finished up with everything, and the last class will be a capsule, just bringing everything together, talking about what I like to talk about what are the major risks you should be worried about from a corporation or an investor standpoint, and the major risk you'd be worried about from an individual standpoint. And we'll kind of bring it up, that stuff that probably won't be too great for adding to the exam. All right, so y'all see the final. Is there any question what's on the final? This is it, right? Which means you've got the answer right there. That is your answer. If you can, you don't have to write it word for word, but that is the answer. I converted this blog into a AI video. It did an okay job of summarizing it. You could copy and paste that into Notebook LM and ask it to summarize it for you. That might help you some to make sure you're not missing something obvious. You might get, I don't know, I've never tried this. You might get Notebook ALM, my rubric, and say, summarize this blog into this framework of a rubric. I don't know if AI could do that. Probably would do it pretty well. I loved what Ryan said. AI is, what should I be most worried about with this company? What's its main, it's like, let AI see if you can figure something out. Not that you're going to use it, but just looking for ideas. So there may be ways to do that. I doubt on this second question, AI is going to help you too much. I'm going to give you everything you need. We have summaries of Orange County, MG, and long-term capital management. We will have a guest speaker in Orange County. John, I think you said it's Bonell is his name. I think we mispronounced. Was it you that met him? Someone met John Bonell in here. Who was that? Someone was talking to me about him. So he's going to talk about Orange County. We won't have any other guest speakers there. So you've got your exam. You know exactly what's on it. Everybody in this class should make an A on this exam. I doubt that's going to happen, but do y'all know I would actually be happy if every person in the class made an A? Can y'all believe that? Y'all don't believe that about your professor Z. You think we're actually mad if everybody does well. I had a professor mad because everybody did well on an exam. And he counted off for not using complete sentences. And I go to him and says, it's a finance exam. I wrote the number. He said, yeah, but the grades are so high. I counted up. I said, and I made a mistake of saying, well, you should make your exam harder. That made him so mad. His final was impossible. I was the only one in the class that knew what he's going to put on the final because I knew how mad he was. But yeah, but I would be ecstatic. If y'all all make A's on this final, I would be ecstatic. I'd be bragging about it on Facebook. All right. Any comments, questions on the final? All right. A few last little notes we can talk about with Doug Hubbard. I do like this idea of contagion. He says, normally things aren't that bad, but when you get into the left tail, the downside tail, things start happening very, very differently. You can think about it as contagion or domino effect, or just things kind of get tied together. Ryan tonight was talking about a contagion because of short sellers and other things. We have quite a bit of leverage on the investment side and can cause things to just unwind very quickly. So the normal distribution works well. This is very similar to what Taleb said. In fact, Doug Hubbard will talk about Taleb quite a bit in some of his lectures. I don't know if he did in the lecture, I can't remember, but financial markets, supply chains, major IT projects, they tend to do a power log. It's kind of normal, but then the tails are just these massively unusual. Part of the reason is contagion. Is that when a system fails a little bit, it's okay, but at some point it fails so bad that other systems fail because of it. And you don't know that. That's what happened to us in 2008. We did not realize how many people had the exact same exposure until it happened. And that's one reason the Federal Reserve started asking for information on swaps and other securities where they didn't have the data is because they didn't know, wow, these four major banks all have the same position on this going in the same direction. Um, so that's the contagion. You just don't realize it. It doesn't really affect you until the losses are big. And when losses are big, you get these massive events. They cause it a common mode failure. You get to a certain point where this thing is so bad, it just drives everything down. Um, when I read through them, he makes a slight distinction between contagion, common mode failure, and cascade failure, but they're very, very, very similar. These kind of chain reaction, domino effect. So if you're using crystal ball or at risk to do some type of stochastic analysis, you might try some other distributions. Actuaries are really good at that, and really looking at distributions and seeing which ones makes most sense. There are some that are just you give them the data and you tell the model figure out what distribution makes most sense given the data we have. I remember at USAA, they were trying to figure out their catastrophe risk, and every chance I got, I went. They had a department that was nothing but PhDs in math. I was over there all the time. I'm surprised they didn't say you're bothering us wrong, get away. They always let me walk over there. And they were asked to come up with a number, and all they had was 3 data points. And the head of the department, he was so furiously mad because they want him to do all this massive analysis of 3 data points. And he was like, how are you expecting us to do that? They came up with numbers, they presented them, and all these major decisions were made. And the head of that department, he was like, this is crazy. I can't believe you're doing that. But anyway, you use the data, as Doug Hubbard would say, 3 data points is better than 0. It's better than intuition. So use it, but realize your data points may ignore the fact that there's something that's radically different than you've ever seen before, and we haven't hit it yet. We haven't hit it yet, maybe with private credit, haven't yet hit it with whatever. Gold prices are down again today. You saw silver fall 20-something% in one day. That's a pretty big event for an asset class like that. Your historical data would have never, silver has never done that ever in its entire history. And then it did it on that one day, so be aware of those things going on. And in his quote, he doesn't leave too many people out. Actuaries don't like this quote because they don't think they're in this group. Engineers don't like this quote, but everybody everywhere. So he's really talking about finance. Everybody everywhere in finance is focusing on the least valuable measurements at the expense of the most valuable. Why? Because that's where we have the data. We focus where we have the data. The strange thing is our biggest risk is where we don't have the data, and that's somewhat related, right? That's the reason it's our biggest risk, because we don't have the data. Everybody everywhere, it doesn't leave a lot of people out, is systematically measuring all the wrong things. It is so pervasive and impactful, I have to wonder how much this affects our GDP. Organizations appear to measure what they know how to measure without wondering whether they should learn new measurement methods for very high value uncertainties. I'd still encourage you to read his book. Even if you find it a boring book, still read it. There's some boring books you have to read. I'm reading a book on Say's Law right now, which is really boring, especially on a bicycle, but I'm trying my best. Sometimes if I don't understand something, I just go back 30 seconds and just listen to it over and over again. And eventually I'll just say, yeah, I'm too stupid, but I'll try. And I love this quote from Lebowitz. The great investors are like the great sailors. They have courage to set forth. They know where they want to go. They have a strong gyroscope to keep them on course. They have an appropriate respect for the dangers of the sea and its potential for radical shifts in weather and currents. And they're not afraid to be alone for long stretches. I think that's what we heard from Ryan. I wish you all could have heard Ryan tonight. He's talking about, wow, there's so many people in this business now, all doing the same thing. What possible value can you add? You're not going to add value if you're doing what everybody else is doing. Now, it's risky not to do what everybody else is doing, but it's also very risky to do what everybody else is doing. You have to know what everybody else is doing, pick up the best things there, but then you have to every once in a while just stop and say, boy, we're doing this all wrong. Should we think about this differently? Is there another way to look at this? And then that was my approach at USAA. Go talk to somebody else in the department that's and me was go talk to the actuaries, go talk to those PhDs in math. Boy, they intimidated me. That guy Paul I talked to, I would take him my models, and boy, he'd rip them to shreds. You can't do this. You're making this mistake. I wanted to know that because we're about to move billions of dollars based on my analysis. The USA thought I was smart. I was like, no, Paul is smart. I just am a better communicator. So, but he's going to keep me from messing you guys up. But that's kind of the thing is go out and talk to these people, take a perspective. And I think that's one of the things Doug Hubbard does that's really good is he talks to actuaries, he talks to engineers, he talks to finance people. He's talking to all the different groups that do a lot of this kind of quantitative risk management. What are you doing? What are you doing? What are you doing? How can we bring this all together? And then what are we completely missing through this whole thing? So be willing to be different. At USA, we talked about the pension plan. We did something no one else was doing. It was pretty scary because I had a lot of fiduciary risk. But I had actuaries that were, maybe I over glamorized them as man, really smart people, but it gave me great confidence to hear someone who wasn't involved in my project look at what I was doing and give me pretty tough feedback. We saw that with Annie Duke, right? Your decision pod, bring in those people outside of your area of expertise that are thinking very differently, and then let them rip it to shreds. Don't you want them to rip it to shreds before you move billions of dollars? Wouldn't that be nice? Wouldn't you like to figure that out versus 2 months later they go, oh, I could have told you that. Yeah, that would have been nice. I wish I had talked to you. So have some, I don't know, fear of your knowledge, fear of what you really have been taught, and be willing to go out on a limb. All right, so these case studies, they're old case studies. I would bring newer ones in, but I can't find them that have these specific. In fact, when I was talking to John Vanell on Orange County, he's like, well, you're still talking about that, but it's such a perfect case. I would bring 2008 in, but 2008 it really was just people ignoring an obvious risk. Maybe I will. There's some good books on 2008 that I've read. It's hard. I've had a tough time to summarize it down in something we could really use that would be valuable for you. I've thrown out the Tylenol case because I do think it's too old, but just if you've heard of Tylenol, so each one of these cases has a main thing. On Tylenol, the main thing was how to manage the severity of a risk, not the probability, not the upfront keeping it from happening, but after it's already happened, how do you manage the severity of it? And they managed it through public relations. They owned the media. They got the media on their side. So they had a product tampered with. Some people died, caused hysteria. Tylenol had to make a decision. What do we do? They decided to pull all the product off the shelves, even though they knew it was very limited. They knew it wasn't their fault. They could tell it did not come from their factory, that it was happening on the grocery store shelf, that someone was tampering with the product, but they still pulled everything. They did what their lawyers told them not to do. So they went out and say, we got to figure out what we did wrong. We got to fix it. They went out just admitting we got a problem. I think if you look at Bluebell, I think Bluebell messed up. I don't know if y'all saw the Bluebell case where they had some food poisoning and just didn't come up and fess up. This is Bluebell, who's like loved by the people in Texas, right? They've got this incredible brand. I think they should have. I don't know if it hurt them long term. I don't eat ice cream, that kind of. I eat ice cream that's for old people. It's low fat and all that kind of stuff. I'd love to eat Bluebell. My boss and the head of department, he used to walk around with a tub of Bluebell, and he would offer us, "You want any?" And then we'd take like 2 scoops, and then he walked around and ate it the rest of the day. He loved it. People love it. It's a great product. I don't know if it's any better than HEB's. Maybe it is, but boy, they could blow it in that one thing where they didn't come out and say, man, we got to figure out what's going wrong. They seem to just say, oh, it's not a big deal. Perrier, the water company, had a similar thing happen to them where they just said, no, not a big deal, not our problem. And boy, I think it destroyed that brand. United Air is interesting. They're the ones who are dragging the guy off the plane. Actually, it was TSA or whoever. People said, I'll never fly from United again. Didn't hurt them at all. Their stock fell, came right back. Doesn't seem to hurt them. You never know. Chipotle had a food poisoning problem. It did hurt them a lot. You can see it in their stock price. It hurt them for quite a while. They have come back since then. I don't get Chipotle. I've eaten there. People like love it. Y'all love Chipotle. I don't get it. It's anytime I go to a restaurant that people love and I think I could do that. I don't think like that looks pretty simple. But anyway, they had the same issue. They're very well loved. And then they had this food poisoning. So these are things that come out of left field. So Tylenol is a firm that said, you know what? We're going to show great sympathy. We got a problem. We're working really, really hard on this. Their lawyers are saying don't say anything. You will see with airlines, if they have a plane crash, a lot of times they won't share any information. It just makes them more likely to be sued. People get really mad. They're like, why don't you give us any information? And that's what their lawyers are saying. Don't say anything. I have an article out there on Canvas, a discussion of doctors after they make a mistake of actually admitting it immediately, and that they have actually discovered they're less likely to be sued if they admit they made a mistake. So how do you handle that public relations afterwards? There's a lot of debate on that and how you can do that. I don't know if there's been a study since that article was done. Most lawyers are going to say just keep your mouth shut, don't say anything. But it just makes people so mad they want to sue you. All right, so that's the Tylenol case. I'm not giving you that one. I do have an entire article out there. You can read about it. It was big news when it happened. They did not have resistant proof caps back at that time. I think you could make an argument they should have, because they're having cases before. They probably should have already done that. But they did fix it. And Tylenol, a lot of people think it would never come back. It has come back. It's not doing as well now, but that's not because of this situation. It's because so many other drugs have come along to compete with it. But let's talk about MG. I won't say this in. Can anybody speak German? Shot. I don't know. There's probably 3 words in there, but we'll just call it MG. So if Tylenol was about public relations and managing severity after event, MG is primarily a basis tracking risk issue. It's not the only thing in this case, but it's the primary thing. So if you write about this one on the exam, you got to make sure that's a big part of it. It includes price risk as well, liquidity risk, disclosure risk, but basis risk is the biggest one. So what you have out on Canvas is a summary of MG. You also have the entire article, but I took the article down because, and maybe I'll put it back up there, but we're being told we have to make Canvas accessible, and PDF articles don't work, so I just took it off because I have to hit 85%. Now they say we have until 2027, so I can put it back out there, but I'll put it out there. The actual article, I'll put it back out there. My 85 will drop down to 81. I'm not sure how to make that accessible because it's really, really old. This is a case Dr. Misra gave me. Y'all are unfortunately don't know Dr. Misra. He retired a few years ago. He was my favorite finance professor ever. Really, really good professor. I had him for 3 classes. Including auditing in a class of his. I wasn't even a student, just a really, really good professor. He said I should use this case in my class, and I thought it was a really, really good case. So I'll just walk through the summary of it, but the entire article is out there, and I'll give it to you. This guy, Franklin Edwards, has written some other really, really good risk cases. So let's start off with, on the exam, you want to start off with just give me some background. Who is MG? So MG is a company in Germany. It's international, but it operates in Germany. It's an oil trading company, or MG is a subsidiary, or MG has a subsidiary, MGRM. There's an oil trading subsidiary. It's trading oil to customers who need oil for some process or other, whether it's some big corporation or some utility or whatever, refiner. So they had a massive, now this word massive shows you how old this article is, because 1.9 billion doesn't sound all that massive anymore, but a massive $1.9 billion rescue operation. Keep it from going bankrupt. It established a large derivatives position in futures and swaps that would have done really well if energy prices rose. So right there on the surface, it looks like this is a firm that's speculating. They're betting on oil prices rising. And so let's look at the period of time we're looking at here, 1993. Here's the case right here. They're going to benefit if oil prices rise. This is oil prices. So how did they do? That looked too good. Oil prices fell down to $14. Can you imagine? $14. It's funny how a few years ago, well, 20 years ago, they're talking about peak oil. What did peak oil mean 20 or 30 years ago? Peak oil meant we're running out of oil. Then fracking came along. Then they started using peak oil again. What did that mean? We're going to stop using oil. That kind of has gone away. So I don't know when we're going to actually have peak oil either way, run out of oil or stop using oil. But at this point, oil prices dropped from 22 bucks down to 14 bucks. And they had these positions where they would benefit if oil prices rose. Are they really that stupid, do you think? Or is there something more to this story? That's how it hit the headlines. Kind of like Pete Carroll should have run the ball. You know, let's look into this lower. Who was showing me? It was you had Dane showing me the video of Pete Carroll. Who was showing me that? Was that Brady? Yeah, sorry, get mix y'all two up all that. Yeah, it was a really interesting video. I think Pete Carroll had a pretty good argument for why he did what he did. So did these people have a good argument for why they did, or did just people say, hey, you know what? I think oil prices is going up. Let's just bet the entire firm on oil prices going up. It was on 160 barrels of oil. They would do really well if prices were the rise. Prices fell sharply. They had large losses, margin calls on derivatives. If that's all you read, you'd say, wow, these finance people at this company were really bad. Now that is my perception of Silicon Valley. Talking to people who had somewhat of an inside scoop on Silicon Valley, they were saying the same thing about that these are people who just messed up on the basics. It's just pretty simple stuff. How did it mess up? I don't know for sure. You'd really want to get inside and hear. Usually finance people at a bank like Silicon Valley are probably pretty smart. So there may have been something going on, but on the surface, it looks pretty stupid. This just looks really stupid. Why would you bet a firm on oil prices going one direction? We'll see that with Orange County that he did bet on interest rates only going in one direction. And we really do. And you'll see with John Bonnell, we can make the argument the guy was way out of his league. John Bonnell has some really interesting insights on Orange County. So why did they do it? Well, there's an other side of this transaction. Why did they buy the futures? They bought the futures because they sold fixed oil contracts. They sold contracts where they had to deliver oil at a fixed price. There, they were going to lose money if oil prices rose. So they needed something that was going to make money if oil prices rose. What would do that? This. So what was this? This was speculation? No, it was a hedge. So how could you have a hedge and you go out of business? Shouldn't the hedge protect you from going out of business? So there's obviously more going on here. So they entered these fixed price for delivery contracts, exposes them rising energy prices because you're going to promise you're going to deliver this oil to people at 20 bucks and oil prices go to 30 bucks, you're in trouble. So they have these future contracts on the other side. Now, what I don't understand on this case makes no sense to me at all. Maybe some of y'all can explain it to me. Who are these customers? And why are they going to MGRM when there's a very liquid futures market out there? Why didn't they just go to the futures market? I don't understand that. So who are their customers are? If you're at MGRM, why would you bring a middle person into this? Why wouldn't you just go to the futures market yourself? You guys can do futures. If you get a good brokerage account, it's not that difficult. You probably can't do 160 million barrels of oil, but you could probably do, 10 barrels of oil or something. So I don't understand that part of it. The article doesn't explain that. But for some reason, people are coming to MGRM and saying, we need you to deliver oil to us over the next year or 2 or 3. Maybe they didn't feel comfortable rolling the futures. You do get roll risk, which we'll talk about here. But anyway, there's people for some reason want to go to this particular company and enter when they're contracted them to deliver oil. Pretty dangerous for them, right? Because if MG goes under, they're now at risk because they're not going to get oil they contracted. So they were actually hedging, but a fixed price delivery contract is an extremely illiquid contract. And they were hedging it with futures that are extremely liquid, priced every day. And even over-the-counter swaps, they're not as liquid, but they are priced every day. So here you have something that's very illiquid, doesn't necessarily have an obvious price to it, where here you have something that you're going to know exactly what's going on. That's going to be pretty important. If this was hedged, this is why I don't understand their customers. If this hedge worked, they were locking in $640 million in profit. 640 million divided by 640 divided by 160. That's $4 per barrel. That does not make sense to me. Because that means the people doing the contracts with them are losing $4 per barrel. So again, I don't know who their customers, maybe their customers aren't too bright. I don't know. That's maybe I'm picking on the wrong IQs, but it doesn't make sense. You might have a good answer why their customers are coming to MGRM if they're paying an extra $4 for a barrel of oil when oil is only $20. We're not talking about it's $100. It's 20. So I can't answer that question for you. But anyway, they're going to gain 164 million off of 160 barrels. That's $44 per barrel. Oh, that'd be good today, though. Even if I could lock in, sell 160 barrels of oil, $100, and I know I'm going to make 104. Yeah, I would lock that in. So it looks pretty good, right? If you're the finance department, you're like, wow, lock in 640 million bucks. That sounds like a pretty good deal. So was this the correct? Would have been smarter for them to enter these fixed rate contracts and do nothing on the other side? Would that have been smart? That seems pretty stupid too. It seems like what they did seems like the smartest thing to do. So was this speculation? Was it bad hedging? Was it just bad luck? Part of it was bad luck because when this happened, they completely replaced the management team. And the board says we had all these speculators. And so what the board said was, right here, shut it all down. Take those futures off. You still have the fixed contracts where you're exposed to rate prices rising. Is this a good place to shut this down? It's like what? The worst possible place to shut it down. So that's the other problem they had. Remember when we talked earlier about communication, make sure everybody knows, hey, if we enter this and oil prices actually fall, you're going to see losses on the futures, but realize board, we got gains on these fixed rate. They may not show up the same way. Again, my experience at USA, they may forget all of that when it happens, but document as much as you can. But the board freaked out and didn't sit down and ask questions, didn't ask what was going on. Let's understand this. They just said, shut it down. And they did it at the worst possible time. So let's give a little bit of discussion from a finance standpoint. First of all, they had contracts for 160 million barrels of oil. So they did futures and swaps on 160 barrels of oil. So they had a hedge ratio of 1. I'm not an oil trader, but a hedge ratio of 1 may not have been the right answer. So what should they have done? Any guess what measurement of risk they could have used that we've been using all the time in this class? I would have done a VAR. I would have tried different hedge ratios with different historical numbers and just to see what is the best hedge ratio here. Why? Well, because especially with the futures, the swaps, you can get a little more control, but the futures, if you got a 5-year contract, you're not going to have futures for 5 years. You're going to have to roll them. And there's things called backwardation and contango. And so you don't need to know these in detail on the exam because I don't know them myself. I'm not an oil trader. You probably have heard these terms before. Have y'all heard these terms before? Backwardation and contango? None of y'all? Anybody? Who has heard of them? So Copilot will tell you. So contango should be the normal one. Backwardation should be pretty rare, but you do see backwardation pretty common. So if you think about oil, so it's really unimportant. It's really important to understand the pricing of futures. A lot of people think futures are predicting oil prices, but not really. I've been seeing that in some articles here recently saying that. So you have a choice. You can buy oil today and store it in your garage for use in 3 months, or you can buy an oil future that's going to make you buy the oil in 3 months. If you buy the oil today, you're out the cash. So you got some time value money, and you got to pay for storing them. Are your neighbors going to let you store 100 barrels of oil in your apartment? Probably not. You're going to have to go someplace and store them. That's going to cost you money. So you can spend the money today and pay for storage today, or you can do the futures contract. Well, if it's going to cost you all this money today, it should be cheaper today because you have to spend all that extra. So if it's going to cost you in time value money and storage $2 per barrel, then maybe you'll pay 98 bucks for oil today and the futures price will be 100. So you're indifferent between buying the oil today or committing to the $100 in the future. Okay, so that would be contango. That's normal. The spot price, I know what the spot price is. That's what you can buy today. The spot price should be lower than the futures price because, anybody know the term? See if it's in Copilot's answer. Ah, there it is right there. Have y'all heard this term before? Cost of carry? Does that sound familiar? Cost of carry. So that's that time value money and the cost to store those barrels. The cost of carry should can make the spot price lower than the futures price. If you're doing the S&P 500, what's the cost of carry of the S&P 500? You can buy the S&P today, or you can do a futures contract to buy it in 3 months. You only have one cost of carry. And what is that? Time value money. So what should be the difference between buying the S&P today or the futures price? It should be the risk-free rate of interest between spending the money today and the futures. If that gets out of whack, we don't talk about backwardation and contango with S&P futures. Because boy, you can make a fortune off of that, but it does happen with oil prices. Why can you make a future on the make fortune on the S&P? Because we can go long and short on the S&P. That's pretty easy. I challenge you to go out there and short barrels of oil on the spot market. I bet you can't do it. Try selling your neighbor's oil and see what they say. It's kind of like trying to short real estate, right? Try to sell your neighbor's house and see what they say. They may not like it, but you can sell your neighbor's stocks. That is allowed. We can short stocks. So the stock market, those very liquid markets where you can go long and short, it should always be contango and it really should be lined up pretty well. I don't know commodities that well when you have things like oranges and coffee, things that can spoil over time. You know, there can be different answers going on, but what you should see with oil prices is oil today should be cheaper than the futures by time value money and how much it costs to store. If you have advantages on time value money and you have advantage on storage, you should just buy the oil today and just store it. If you don't, you go in the futures market and you'll do better. Backwardation is futures prices are lower than the spot price. That does happen. It can be, we saw a few years ago where the futures market actually went negative because there's no place to store all this stuff. I don't know if you remember that. You probably could have made a fortune on that if you had a huge gymnasium and you could have accepted 1,000 barrels of oil. I'm not real sure it would work because I'm not so sure the transportation mechanisms of the oil industry would suddenly be able to deliver to San Antonio and give them your address. Hey, can you send those over here? But you could have conceivably made a fortune. But traditionally, contango says future oil prices are not a forecast of where we think oil prices are going. It really is a reflection of this arbitrage. You either buy the oil today or you do the futures market, and those two should be equal. Otherwise, there's some things you can do to try to take advantage of it. They even say it's inflation expectations, but that's not traditional approach. So when you talk about value at risk, it's really important that you have a starting point. Is your starting point contango or is it backwardation? Because that tells you there's actually a relationship between contango and backwardation and what oil prices do. So it's really important when you're doing your value at risk that you have all the data set that you have in there, so you're building a really good model. If you're doing a value at risk on interest rates, you better know if the yield curve is steep or flat or inverted, because that's going to tell you where it's most likely to go next. If it's really steep, what is it likely to do? It's likely to flatten. If it's inverse, what is it likely to do? Likely to steepen. But how is it going to steepen? Show you how you make money. Is it a bear steepening or a bull steepening? Have y'all heard those terms? How can a yield curve steepen? The short end can fall or the long end can go up. When these stocks lose, when the bonds lose money, when interest rates rise or when they fall? When they rise. So which is the bear steepening? When the short term falls or when the long end rises? It's going to be a long end rises. That's going to be a bear. So if you're in a steep yield curve, you ask the other question you ask, okay, it's likely to flatten. Is it going to be a bear flattening or a bull flattening? What would a bear flattening be? The short end comes up. What would a bull flattening be? Long end comes down. All right. So you see with VAR, it's not just a matter of going and get historical interest rates and just say get the mean and correlate. You got to look, where are we starting? What's likely happen next? If the yield curve is inverted, history, you're going to go back and look at history when the yield curve was inverted and look at what it's going to do. So same thing here. What you're talking about right now, we're in a period of time where the Fed just finished cutting rates. It's extremely rare for them to cut rates like they did and the next move be a cut in rates. You can go back historically. I can't think of a time actually where they cut rates and they went flat for a long time and then cut again. That may give you some insights, but when you're building your value at risk model, stop to think, where are we currently? Is there anything unusual about this current case? Is there a previous time or times I can look at that? And that's really what I would have, if I'd worked for MGRM or if I'd worked for Silicon Bank, I would have built the value at risk model. So Silicon Valley, they had a very steep yield curve where short-term rates were extremely low. Okay, do I really want to bet on going out on a yield curve if it's really steep? Because a good chance the short end is going to come up and the long end is going to go up and I'm going to lose a fortune. So you see what I'm talking about with valued risk. It's more than just getting historical data and plugging it into a standard deviation model. You really got to think about the starting point. So in setting up the hedge, they use short dated futures and swaps, which you kind of have. They could have used longer term swaps. That probably could have worked, but they use short dated. These had to be rolled forward continuously. That's not disaster. You get these gains, you roll the gain forward. It does a pretty good job of reducing your risk. As your customers took delivery, you would shrink the hedge along the way. So you might start with 160 million barrels and you're down to 120 to 90 as you go along. But this creates roll risk. So that's one of the risks here is roll risk. Whenever you're doing hedging, your hedge has a different time duration than what you're hedging. And in this case, they had the difference. So they had roll risk. And backwardation and contango create different roll risk. It was interesting. I talked to an oil trader, and I think I told you all this story. I asked him, where do you think oil prices are going? And he said, I have no idea. I was like, how could you not have an idea? He's like, yeah, we don't really do that. What was his entire job? His entire job was to take advantage of backwardation and contango. So he said when the markets were in backwardation, he had a lot more opportunities to do stuff that were more interesting. But he knew this market extremely well, but he didn't have an opinion where oil prices were going. Or he might have, and he didn't want to tell me. But anyway, so understanding that to start with is really, really important. So what went wrong? So here's what you're going to do on the exam. You set up the problem, and then what I want you to do is talk about risks that we talked about in this class. And so have, your outline. If I give you, an outline, you may just say, here's the 6 risks I need to talk about. And then maybe you give yourself a few extra words if one of them was a little more difficult. So energy prices tumbled. You could call that price risk, maybe, but they were hedging, so that shouldn't have been an issue. But part of the problem for them was the liquidity crisis. You had futures and swaps that require cash calls. So when those prices fall, they had to send cash on the futures. But you had these long dated contracts where they didn't have cash margin requirements. So I've got this future. I got to send cash to my broker, but I got these long contracts with these customers. I don't have a requirement that they send me cash as a background, backup just in case, something happens to them. So I got this liquidity crisis. What am I going to do? When would you want to think about this liquidity crisis in this process? The day they set up the futures? When this process would you think about liquidity crisis? When would you be calling your banks to say, hey, we're entering futures contracts that might have cash calls. We need a line of credit. Would you call your bank the day before you do this futures contract? Would you wait until after oil prices fall to 14 bucks and then call your bank? When would you do this? I think I'd start like 6 months out. We're about to enter this. We're going to have these contracts. It's not speculative. It's backing this other side. So any losses we have in the futures, we've got gains on these long contracts. Why don't the banks say, yeah, we're not going to do that? That kind of gives you an answer. You got a problem. Now what you got to do is you got to go to those people you're selling these forward contracts to and say, hey, if oil prices fall, you're going to have to send us some cash because you're promising to buy oil at 22 bucks. Now oil's 14 bucks. You could find some out to get out of the contract, and now we're stuck with with having enough oil that's down at 14 bucks. So you got to think about that liquidity side. How do you do that? It's exactly what we talked about. It's stress tests. An obvious question to ask would be what? What happens if oil prices fall 8 bucks? And maybe an easy question to ask, right? It's not too strange here. Oh, wow, we're gonna have to send money to our broker. How much money will we send if oil prices fall 8 bucks? Oh, wow, it's gonna be 20 million bucks. Where are we gonna get that 20 million bucks? It seems obvious after the fact. Do you think they had those discussions? There's a good chance they might have. I don't know. Sometimes finance professionals are like, if we have the discussion, we'll never get this transaction done. Let's just do it and just hope for the best. I think sometimes finance does that because it's like, I really want to get this thing done. Or maybe the company's already entered into those forward contracts and it's kind of, is it the cow that's out of the barn or the horse that's out of the barn? Where one of your animals is out of the barn, it's already too late. Now you got to hedge it. Maybe you don't have time. I don't know. Wouldn't you love to know the details on these cases? Because they're always a little different. This is why I don't like case studies at Harvard, because I think the real world is far more complicated than the case. But anyway, it sounds like they didn't look at it. So when oil prices fell, they got to send cash to their brokers, but they're not getting any cash from their long contracts. The rollover risk of gains or losses when short positions are rolled each period. So it's not large. There are small gains and losses because of backwardization and contango. You have these small gains and losses. It's not going to crush you, but you do have them. Losses on rollovers resulted from an unusually long period, a price contango in the market, leading to larger than expected rollover costs. So contango created special things. So you had contango for a longer period of time than you had in the past. So the past didn't quite predict itself. But if you're doing value risk, you'd want to kind of look at those prior periods. What happened to these futures contracts when we were in contango for a long period of time? We were in backwardation. When they switched suddenly, you would know that the guy I was talking to on the phone, the oil trader, he knew this backwards and forwards. I mean, this is what you get excited about as a finance major. You're going to be that person in whatever your field of expertise is. And isn't it exciting to think you're going to be there probably in 3 or 4 years? To me, it's really exciting. I like to tell people I know a whole lot about very little because that's what finance is all about. You just learn it extremely well. So valued risk is perfect for this type of analysis. You go back and you just hunt for all the kind of data you have. At this point in time, it's been pretty tough because we didn't have a lot of online data just sitting there at disposal, but I would still have found it. We did have Excel in that year, so they could have done some stuff there. There is also a positive relationship between contango and falling energy prices. So that might have told you, we have a higher chance of getting a cash call than we normally do. So kind of forgetting about correlation. Funding risk, that mark to market, we kind of talked about that. They couldn't borrow against the gains on the forward contracts. Although they might have been, if they sat down with the banks in advance, I think there's a chance they could have found a bank. The bank may have charged them an extra fee, might have been a little bit expensive, maybe 15 basis points or something, to set up a letter of credit. But you can set up letters of credit and pay for them, and the banks will do that. They're very skittish about these kind of things, but they will do it. So you have this cash flow matching problem, and essentially it comes down to it's a basis risk. What they were hedging and what they were using to hedge with were very, very different instruments from a pricing standpoint, from liquidity standpoint. So they had this basis risk. So the reaction to short-term derivatives versus those long-term contracts that caused them some problems. They had credit risk. Now, this is not talked about in the article. This is one I think about, is you're promising to deliver oil for 22 bucks. And so you go out and you buy the oil at 22 bucks and oil prices fall. So now you've got all this oil at 22 bucks, and the person who's going to buy it from you at 22 bucks, they go insolvent. So now you got this oil that you paid 22 bucks and oil is now worth 14 bucks, and the person who was going to pay you 22 is no longer in business. What was the credit risk of these entities promising to buy oil from this company? That would be pretty important. If I were the bank doing the letter of credit, that would be a big question for me as well. And then disclosure risk is a big one here as well. And here is the accounting. So you got German accounting versus U.S. accounting. U.S. accounting, mark everything to market. Mark those future contracts to market. Mark those forward contracts to market. Everything looks wonderful. U.S. books look fine. You got losses on the futures, you got gains on the forwards, line it all up, looks wonderful. German accounting didn't do that. German accounting, you marked the futures to market, but you didn't do anything with the forward contracts. Well, if you're an investor in this company and their U.S. accounting looks great and their German accounting is blowing up, how long are you going to sit and talk about that? You're going to tell you, oh, don't worry about it. You're freaking out, right? It's like, man, this is what's going on with this firm. So one large losses in one place, no losses in the other place. And then the board reacts very quickly and drastically. If they could have found some way to find the liquidity, maybe they would have paid up for it. Would have been expensive. Would have been a much smaller loss than what they ended up with. The board came in and just assumed the strategy was flawed. They didn't actually go out and do research. Part of this is, who is the board? Y'all saw this with your banks, right? How many of y'all looked at the members of the board of your bank? It's not all bankers, is it? Banks are pretty complicated. I think NVIDIA is a really complicated firm, but I don't think the CEO of NVIDIA would be all that knowledgeable of JP Morgan's business any more than Jamie Dimon be able to go in and be on the board of NVIDIA. They're smart people, right? They could probably figure out some of it, but they're not going to know it as well. So it's tough. You're on the board of this and you're just looking at it and say they messed up. You're gonna act. And remember, you as a board member, you have personal liability. You can be sued by the stockholders, so you're also freaking out on that case. So again, the board shut it all down right at the bottom, worst possible thing to do. This is something you're doing a contract like this, you make sure the board knows exactly what you're doing in advance, make sure management knows it. My job at USAA with a pension plan, because that was such a radical thing, just keep reminding them what we're doing. This is what we're doing. You may see losses on those swaps, but if you see losses on the swaps, we're making money on the pension liability. Trust us, it's working. I realize it didn't work in 08. We made money on the swaps and the liability fell. They were lucky, but still just remind them constantly. It's something I would tell the CEO, because Automa scenarios were scenarios where interest rates are falling, because he just want to look at history. I kept telling him, this strategy, if rates rise, you're going to see it look very different. He's like, as long as I was showing him actual historical data against our strategy, he was fine. But I kept trying to remind him, we don't like to do that in finance because they're so worried they're going to say, well, if that's the case, let's not do it. We want to get it done, but you're much better off if you make sure everybody understands exactly what you're doing. That may have been the case here. They may explain it to the board 16 times. But again, most boards meet 4 times a year. I remember on the pension plan, I would sit down with the exact council members one on one, and when I left, they understood it. They're really smart people. They understood it. But 30 minutes later, they completely forgot everything because they have their job. And so when they go to the committee meeting, they don't remember what I told them. And it was really frustrating, but you're not dealing with, these are smart people, but they're smart people in their field. And you're coming in with stuff that just makes so obvious. It's so obvious to you, and you're frustrated because they catch on too fast. So I was lucky. Some of the people I dealt with were really fast studies. Joe Robles, our CFO, there's nothing I could bring to him that he didn't figure out very, very quickly. Butch Facilial, who just passed away here recently, he was kind of second in charge there. I love talking to the guy. Anything you told him, he understood it immediately. But other people, it was just so far from their area of expertise, it took forever. So you just got to take this as part of your job in finance, is when you're going to do those really sophisticated, advanced strategies, you're going to spend some time convincing people what you're doing and make sure they understand it and keep repeating it. I think a lot of finance people, they get approval, and it's like, never speak of this again, so that they don't come back and get worried, but that's not the way to do it. So sometimes the biggest risk is the communication side, making sure management understands what you're doing. How many years of oil prices can you get? At this time, it was probably in a book somewhere. This is 1993. Did we have the internet in 1993? It was close. I had a boss who was running around everywhere using the phrase surf the net. And everybody thought he was the coolest person on the planet. So, and that was about that time frame, 91, 92. So I don't think you were getting massive amounts of data off the internet at that time. It may have existed and you could do stuff. But this is a company that deals in this, so they should have it somewhere available. Someone's keying in number. When I was at USA, but we had a database that had every asset class we could find with monthly returns back as far as we could get it. And that database, I mean, we just kept adding to it. If we couldn't find a database, we'd find another one. So in emerging markets, we found a really good emerging markets that only went back to 1980. But then we found a substitute that went back to 72. Same thing on real estate, investment trust. And you put all that in there. So, think about it. In your job, you're going to be building these databases so that if you do need to run a model, you have all the data you need, but you're kind of in the place where you can get this data pretty quickly off of Bloomberg. That's why you got to learn Bloomberg and Capital IQ and these other databases, because that's where the data is, and you get your hands on it quickly. And if your firm's not subscribing to those sources, you may be the one to talk them into doing it, because this is really important for you in finance. But they should have had this data in Excel somewhere, even if you manually keyed all the data. I remember one job I had, we were doing a float schedule, and the only data they had was in reports this thick. And I went in on the weekend and I just started keying daily transactions back as far as I could go, and what time, because back then float was a big deal. If you got your checks to frost by 9 a.m., it made a big difference between getting there at 9 a.m. versus 9:30 a.m. I need to know when the checks came in, and my only database was a report that thick. So yeah, it's kind of what your parents said, they walk through 18 feet of snow to get to school every day. But it really was that bad. But if you need the data, sitting there for 10 hours and keying it in, you can add a tremendous amount of value. If you're the one willing to do that, you may not be the one willing to do it, but and I looked at that and said, and I went back to that department and said, you should have people come in at midnight and process checks, because we'll save millions of dollars. I didn't recommend it. I think the way I said it is, I'm not recommending anything. I'm just letting you know we'll save millions of dollars if you have people come in at midnight. And she said her department put my picture up for a dartboard. But they actually loved it because they got a shift differential. So they actually liked it. They got paid an extra 50% for coming in at midnight. But yeah, I just did the math, right? You do with it what you want. But to do the math, you got to get the data. So if you're not thinking as a finance major, where is the data, how to get my hands on it, just start thinking about it now. If you don't have a Bloomberg account, you don't have a Cap IQ account, I would get one. Start learning how you get your hands on this data. It's pretty important. Brennan can show you his model, right? You just click the button, even use Claude to help them reorganize it. That is your profession as the finance major. Where's the data, how to get my hands on it, and then what I do with it when I get it. So if I were working at this firm, if I could find one of those Standard & Poor's books with 50 years of oil prices, I would have been typing that into Excel if I had to, because that's how important this type of analysis is. All right, who can summarize this case for me? The biggest risk was what?
Basis risk.
Basis risk. Someone said, I don't know if it's in here or not. I think I put it in the quote. Yeah, it's in the article. I love it. He said, hedging is speculating on the basis. So I would work that into an interview. It says, not only I'm going to help you manage risk, but I'm going to help you managing the risk, because hedging is speculation on the basis. I'm not going to say, hey, you got this exposure, I'll just buy this futures contract. No, I'm going to look at that futures contract and make sure those times where it doesn't line up, that we're covered, we're ready to go, we know what we need to do. So that's a great, great, great phrase. Hedging is speculation on the basis. How strong is that particular hedge you set up? And the main thing you're looking at is, when does it blow up? What's another risk that they had? Think through all your risk. Think about the futures versus the forward contracts. Funding risk, liquidity risk, funding risk. What are those futures going to do? They're going to have cash calls. The forward contracts don't. That talks about lining up with those banks. Make sure you have that set up in advance. That's maybe one of my biggest things to say on risk management. Get everything set up in advance and test it. Make sure it's working, because things take longer than you think. What's another big risk here? Liquidity risk, funding risk, basis risk.
Duration count.
Well, duration is part of that kind of basis risk, I think so. Yeah, you could definitely bring in the duration. The futures are 3-month contracts, and you got these 5-year forward contracts. So you could definitely bring that into the basis risk. That's part of what we call, you're saying duration. Another word the way you could say it is the roll risk. You have the rollover risk. You could certainly bring that in as a duration. What was the last one we just talked about? There's 2 others in there we talked about. Well, credit risk, 3 others we talked about. Credit risk. Credit risk was not in the case, but I bring up credit risk. I think that's pretty important. What was that very last one we talked about? Communication risk. And then before that one, a huge one, was that accounting. This is another thing I think I always struggle with this one. Y'all heard about it on the currency side, man. It's easy to manage. It was pretty easy to manage currency risks, but I couldn't manage the accounting for the currency risk. The accounting sometimes is just a mess. And the accounting rules, they don't always do what you want them to do. So you may have something perfectly hedged, but the accounting won't reflect it. You better know that going in. You don't want to learn that after the fact. It's like, wow, what happened? Oh, we didn't think about that. Yeah, German accounting and US accounting, yeah, those are really, really different. That could cause it. Maybe they thought about it and they said, well, handle that when that happens. Or obviously our stockholders are a lot smarter than that. Maybe they're not. So, you've got, now could you write an essay on this case? It's not that difficult, is it? How many pages would it be? I don't know, a couple of pages, you could probably cover it pretty well. Not that I'm gonna give you pages, but if you ask pages, it's gonna be handwritten, so you're gonna run out. But you need to handwrite, because I think some of the CFA exam may still be handwritten, maybe not. Mine was handwritten, and boy, it was tough. But could you handle this as an essay? It's all there, right? You don't even have to read the bigger article. Everything you need is in my summary, right? So there's one case down, not too bad. All right, when is John Bennell coming in? I gotta see him. So I might change the date when I do Orange County. And John Bennell's a really great speaker. He's coming the 28th. All right, so this works out good. So on Thursday, we will do Orange County, and then next Tuesday, you'll get the real story. You'll be hearing about using astrology to make fund allocations and other strange things going on. So I'll let you out 6 minutes early so you can decide if you want to do this as your essay for exam one. All right, we'll stop there. How are the projects going? Everybody feeling pretty good about them? Following the video, you have a pretty good paper to look at the end that gives you some sense of it. If you're not sure, set up a Zoom this weekend. I would recommend finishing the paper this weekend so you can spend the next weekend working on the exam because the exam is really around the corner. We lost a weekend. It's usually 2 weeks away. Now it's only 1 week away. So if anyone's having any struggles, let me know. Most students do really well on this project, and some students in this class really need to ace this project after exam one, and you don't want to repeat. If you had struggle with that exam one, you don't want to repeat on exam two. So some people need to really do well on both. So, but let me know, keep me posted. My schedule gets pretty crazy because my security analysis class is, it's 5 to 7 to 10 presentations a day. So I'm on Zoom constantly this next few days. So, all right, we're going to talk about Orange County tonight, and then again on Tuesday night tonight, I'm going to give you the outsider's view of it. I want you to think about this from an investor standpoint because that's what you're going to see on Tuesday as an investor. You've got a county that's very wealthy. It's highly rated. It's got someone who's got the reputation in the front of Business Week as being one of the best managers in the country. It's a big investment. So if you don't have it in your portfolio, you're taking somewhat of a risk that, you're not going to be, but they do really well and they've done really, really well historically. If you don't have it in your portfolio, you really could struggle. And that's what, when you hear from John Bonnell, that's what he's going to talk about is this is a bond you want in your municipal bond portfolio. So let's see from the outsider after the fact with hindsight, how smart we are. And then we'll see John, who didn't have, the after the story information, how he figured out. So he was famous. I couldn't remember who it was. I thought it might have been John Bonnell, but I was in CFO. I was in the holding company at the time. But I just remember the rumor going around. Some security analysts in the investment company saw Orange County before it blew up and got USA out of it. And so when I started doing this case, I thought, man, I should find that person and invite them to come talk to the class. So I texted my friend at Victory Capital, Brian, who was that? Was it guy? Was it Tony? Was it John? He said, no, John Bonnell. So I emailed him and said, you want to do a story that old? I said, yeah, there's a lot of really good information in this case. It's a really good case, even though it seems small today. So John's a good guy. I loved working with John just because he's one of those people who's always positive and encouraging, always, the jokes, making fun of you and that kind of stuff. Just a fun person to be around. So I think you enjoy talking to him, but he has some really, really interesting insights. So tonight, try to think about this as an investor going into this. And when you see the problems, how would you have figured those out as an investor? And then he'll give you what he actually saw and what information he was hearing. There is some discussion of insider information, but he will address that, how he handled getting information that could be technically insider information. I think he handled it as well as you could in a situation like that. That's pretty important. What happens if you use inside information to trade? You go to jail. Right? So it's pretty serious. You'll learn if you work in the investment world, if you ever get inside information, the first thing you do is you call your lawyer in the firm and say, I just heard this information. What do I do? You're not going to trade. You're not going to touch anything. Your lawyer is probably going to call the firm and say, we have this information. You need to report it immediately, get it out there. So it's really, really critical. So he maybe address that risk from the investors, from you being on the security analysis side. It was interesting Tuesday night talking to Ryan. When Ryan's going to join us for lunch in New York, talking to Ryan, someone asked him, what do you do with your personal portfolio? And what did he say? I don't do anything. If you work in this industry, you shut your entire personal portfolio down. That's what I did. I just stopped trading, except for my 401k. I could do all the trading one, they didn't care on the 401k. But anything else, I couldn't do it. It just wasn't worth it. So it's so John, we'll talk about that. So we could actually get from John not just Orange County, but his remember your personal risk, your career risk side of this story. What happens when you uncover something like this? What if it is in that side information? What if you do get your company out of Orange County, which is one of the predominant bonds in most municipal bond portfolios, and it doesn't fall apart? You know, there was a lot of career risk on his side, so you got to ask him questions about that. You can see if the information he had would be enough to get your firm completely out of this bond that almost everybody has, or if he was taking a risk. So, don't assume I show you this. Oh, that's so obvious. Yeah, don't buy that bond. It's so obvious what John Dell did. It's not obvious. It seems obvious after the fact. We were talking about that, Brent and I before. It's like you got to make a decision. And if you're waiting for perfect information to make a decision, guess how many decisions you make? You don't make any. So you got to go with what you know. And that's what John Bonnell did. He comes back and say, man, I was hearing some wild stuff. I think we should get completely out of this bond. They're like, what, are you crazy? Get out of Orange County? Yeah, I think we should get, he had the guts to say we should get, you mean we should cut 10%? No, go completely to zero. That is a risky proposition in this type of investing. So let's look at it. It's going to seem obvious because we're looking at it with hindsight. So at the time this happened, it was the largest municipal failure. I think there's been a couple larger ones since, but it was the largest one. I know people talk about New York City, but there was a lot of bailing out on that one. We know Illinois right now is in serious trouble. There was a county in Alabama that really blew up. So, but Orange County is such a wealthy county, a lot of very, very wealthy people. And so if you adjusted it for inflation, it probably still would have been one of the largest, if not largest, municipal failures. So what is a municipal bond? It's cities, it's states, it's counties, it's hospital districts, it can be school districts, it's non private firms that are government or government kind of related entities like health districts. They generally get favorable tax treatment. Not always, not all municipals are tax-free, but the majority of them are tax-free. They get tax treatment at the federal government level. What we don't notice in Texas, they also get tax treatment at the state level. And so California has a state income tax. And so obviously, and California it's not just buying municipals, you have to buy California municipals. So you imagine if you have a California municipal bond fund, of course you can put Orange County in it. It's going to be one of the biggest holdings. And so, this is pretty critical. I have municipal bond holdings. I still use USA's fund to try to avoid some tax. So it's an important asset class. So who is Orange County? At the time this article was written, it was the 30th largest. If it had been a country, it would have been the 30th largest economic power. Today, I think they're even ranked higher. I don't know if y'all noticed. Everybody in the U.S. is like, we're all crying about how poor and deprived we are, but the U.S. is doing a whole lot better than Europe and most of the rest of the world. It is pretty amazing that most big European countries are poorer than Mississippi and Alabama. I mean, it's pretty amazing how wealthy the U.S. is, but at this time, they were 30th, so they might be ranked even higher. California would be one of the largest countries in the world. Now, real important to this case, if you're going to do this on your exam, Orange County was an OSIP, an investment pool. Think of money market. This is not a bond fund. This is a money market account. What's the duration of a money market account? Is it 0 or 5? Do money market funds take interest rate risk? No, the duration of money market account is practically 0. When interest rates go up, their bond prices don't change much, their income goes up. Interest rates fall, their bond prices don't go up any, but their income falls. So it's essentially like, it's a very, very, very short term portfolio. That's what it was supposed to be. We'll talk about what he actually did. He was not supposed to be taking interest rate risk. What do you think he did? You roll the dice on interest rate risk, just like Silicon Valley Bank did. I may have to do Silicon Valley if I ever find a good article on it and talk about it because it would be another good Orange County case. So it wasn't just Orange County. It also had some other investors, other counties, those that didn't have a good investment pool, they would actually give their money to Orange County and let them invest it for them. It seems pretty small, but this is a lot of money if you adjust it for time, $7.5 billion. It had a regulatory body. This is important to this case as well. It had a five-member board. However, the person running the OSIP was an elected official. When you have an elected official and you got a supervisory board, what do they like to say? Hey, the voters voted. What are we supposed to do? We're going to take someone out of office that got voted in. So the supervisory board were essentially hands off, not our problem. How do you remember who ran Orange County? Just think citrus. Robert Citron. He has passed away. I was looking at his biography. This really harmed him. He had some. I think he spent some time in jail. I think he also had some pretty serious mental breakdown or just stress-related breakdown. But I saw some articles where it looked like he somewhat bounced back and had a decent life there at the end. I'm not saying he was a horrible man. As you read this, also think about this. What if this was your first boss? You wouldn't want this to be your first boss, more than likely. I had some good and bad bosses during my time. You have to learn how to manage them. I might have been the good or bad boss during my time. Depends on who you talk to. He did not have a degree in finance. I think that's kind of nice versus our next case. Here's someone who didn't take this class, and if he had taken this class, he probably wouldn't have gone insolvent. That's kind of nice. The next case are people who would have been teaching this class, and it would have been a really easy class, and they also failed. So a degree helps, but finance is not going to get replaced by engineering and MIT grads. You know, even they can mess up. So that's why I like Orange County versus long-term capital. You got the two extremes. The basic stuff we did in this class would have saved Orange County, probably would have saved Silicon Valley. But then the next group, who was way over our heads mathematically and everything else, they also failed. There's got to be some balance between the two of them. He was a Democrat and a heavy, heavy, heavy Republican county, and he won with 60% of the vote. And he had his picture on the front page of Business Week as the best investor in the United States. So if you're a municipal bond investor, sounds pretty good. It sounds like a pretty safe investment. Let's look at his credit ratings. Oh, it's highly rated. Well, what could go wrong? This sounds pretty safe to me. He had been in position for 24 years. He'd been managing this OSIP. He earned 9.4%. Now you might say, well, for how many of your money market accounts are earning 9.4%? But this is a 94. That's what money markets were making back then, not that much. So other money market funds were making 8.4. He made 9.4%. Man, this guy is really, really good. I wish I had the Business Week article with his picture on it, but was getting great press. That kind of went to his head. When do you know a finance person is about to mess up really badly? When they're really confident, when they're really proud of what they've just done. You know, anytime you get cocky in finance, you're about to crash. So he's been doing really well. In 94, he had this guy, John Morlack, who actually took his place after the crash. John Morlack came out and said, this guy is rolling the dice. That's not something good to say about something like this. It's not good to run for office and actually create a financial crisis for the office you're trying to take. But he came out and said Citron believes he can accurately predict interest rates. And Morlack says that's impossible. Citron's like, hey, I've been doing it the last several years. So, you know, what are you criticizing me for? So he said Citron's making a bull market bet in a bear market. What is a bull market bet in the bond market? Well, for an OSIP, there isn't really one. For OSIPs, you don't bet on interest rates. So about the only bet you can make is on credit. Citron didn't make credit bets. He was buying very, very high quality bonds. So what was he betting on? Well, he can't bet on interest rates. He's an OSIP. He can bet on credit, but he didn't bet on credit. So what he did, he bet on interest rates. He did what he wasn't supposed to do. He bet the interest rates would fall. Here's the interest rate environment no, it's not interest rate environment. Where is this interest rate environment? Oh, there it is. So here's the interest rate environment of that 9.4 year. What would this line look like? This is 90, 93. What does this chart look like the previous 10 years? Interest rates falling, 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 falling. If in the 80s, if you've been betting on interest rates falling, you're making a lot of money because that's all they did in the 80s into the 90s. Just fall, 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 fall. So when I graduated from college in 86, my CD matured 15% yield. That's a pretty good CD rate. You're probably not getting too many CDs today. I saw some today at 4.6 was kind of the high, or 3.6, kind of the high end. Maybe higher if you go out further. So you have someone who's betting on interest rates falling during a time when interest rates are falling. How could that possibly go wrong? So when does it go wrong? This is the year of the election, 93. Citron's bragging. Look how good I am. The last few years, if you've been buying nothing but the Mag 7, you've been bragging. The Magnificent 7 going to continue to outperform every year forever and ever and ever? It's possible. If in 97, 98, 99, if you've been betting on .com stocks, you're making a fortune. If you've been betting on value stocks, you're an idiot. But he had this cycle where he's betting on rates falling and they've been falling. And so is he skilled or is he lucky? So the question is, what is his model to predict that interest rates are going to keep falling? They're already down to almost 5%. They were at 15 or even higher, 18%. Now they're down to 5. Why would he think they're going to keep falling? And then what happened? Who caused this? Anybody know? Not Bernanke, not Yellen. Who was there before Bernanke? Has a color in his name? Who's the only Fed governor who had color in his name? Greenspan, right. What did Greenspan do? Y'all know who Greenspan was married to? Really interesting story. You may know. I think this is so fast. I went to an inflation conference, which was nothing more than a bunch of economists. Over half the presentations, I had no clue what they were talking about. Their formulas, they had to keep flipping slides to get to the end of the formula. And yeah, it's like, what? That's where Milton Friedman actually spoke there. I actually saw Milton Friedman. I didn't get to shake his hand, but I saw Milton Friedman. He's passed away. If you have a chance to go to YouTube and listen to all Milton Friedman's YouTubes, they're really, really good, or read his book. But Greenspan was married. Any guesses? So at this conference, a narcissist. So at this conference, they knew Greenspan extremely well. So I happened to sit at a desk with some of those prominent at the table. I have this knack. I don't know how I did it over my career. I didn't always plan it, but somehow I got at the table with these really prominent people. You would think I was like, I just sat down and suddenly, so these really well-known economists sit down and they start talking all the soap opera stories of Greenspan and other people. I was like, man, this is pretty incredible. So they're talking about, what Greenspan does away from work. Andrea, it's not coming up. Mitchell. So who is Andrea Mitchell? You may know her, not personally, but she was a famous news reporter. That's pretty interesting, isn't it? You got a media person married to a Fed governor. If I were she, I would have my notebook out and hope Greenspan spoke in his sleep. What do you think they talked about? You think they talked policy? I mean, it's pretty amazing. So I don't know how long they were married. They're saying, does she look familiar, Andrea Mitchell? I don't know if she's still alive or not. It just seems strange to me that these famous people date each other. It's like they shouldn't even be getting married. But anyway, Greenspan for some reason woke up one morning. Maybe Andrew Mitchell said something to him, and he said, "You know what? I'm worried about inflation. Who knows why?" And he shot interest rates up to 225 basis points really fast. At the end of it, he said, "You know what? That data I was relying on wasn't all that good. That wasn't good. Let me undo that." So he shot him up, shot him right back down. But if you're Citron and you're betting on rates falling, does that look like a good bet right here? 1995 was one, or 1994, 95 was one of the worst years for bonds. Interest rates just shot up. We saw that in 2022 because of inflation. Here, it was entirely driven by the Fed, just because Greenspan, for some reason, decided. And that's how much power he had. Today, that doesn't work, right? Because you got to get all the governors to vote, and they're all disagreeing with each other. Back then, he wielded tremendous power, and he decided just to raise rates just overnight. I would have loved to have heard a discussion on that. Part of it is a lot of these reports that come out, they get revised and adjusted. And he finally said, I somewhat overreacted. But that's the environment when we have someone who's been betting on rates falling when all they've been doing is falling. You have this election, more like is saying, this is not the time to be betting on rates falling. More like was right. What is he right or just lucky? And no one could really say that Greenspan was about to do that. Um, your best bet is they're just going to stay at 5%. They just go sideways, up or down. Who really knows? So, so Marlack's coming in and saying, man, he's making a bull market bet. What is a bull market bet? That's a bet that interest rates are going to fall. If you're money market, it's not, but he's not a money market. He's actually managing this thing as a bond fund when he should be managing it as a money market. So what went wrong? So let's just go right into the issues. We start off with the operational side, and that's the lack of supervision. He had a board of supervisors, but you have someone who's elected and who has an incredible reputation. Someone who's been betting on interest rates falling during a falling interest rate environment. You can't really go wrong with that. Citron did not like being supervised. That's why I don't think he would have been a good first boss. I was really fortunate most of the time to have bosses that I could question them, challenge them. In fact, my first boss's boss, he would take you on. He'd probably embarrass you pretty badly, but you could take him on and he loved it. He took it as a challenge and he didn't hold it against you. So you could really challenge him. When I worked with Bob Davis, CEO, you could challenge him as long as you didn't embarrass him in front of other people. You could challenge him, especially one-on-one, and he would take it on. So most of the time I could do that. I had a couple of bosses that weren't quite into that, but most of them, and you want a boss like that. Your first boss, it's really important that your first boss lets you embarrass yourself, ask stupid questions, really challenge things without making you feel stupid. That just, if you're scared to ask the question because you don't want to be embarrassed, you should go ahead and ask the question and just take the pain. But Citron would not have been a good boss because he did not like being challenged. He even argued that oversight was harmful because he needed to be able to maximize market opportunities. And so his success somewhat justified that. There was an independent audit, or at least 4 independent audits done. None of them led to any restriction, even though he was violating policy. You would think the auditors would have found that. There's another famous case, Barings Bank. We won't talk about Barings Bank too much, but Barings Bank was the Queen's Bank. It went insolvent. It went insolvent because Nick Leeson, he was hiding some trades. He argues in his book, he tried to make himself look like he was a good guy who just things went wrong, but someone in his department made a bad trade, made a mistake. So Leeson doubled down to try to get it back, and it worked. And then the next time it happened, he did it again. That time it didn't work, and it started snowballing. And so he had at Citibank a $300 million account that had no money in it. That's pretty easy for an auditor. You just call the bank and say, is there 300 million sitting there? And Nick Leeson, Barings Bank is a pretty kind of one of the oldest banks, if not the oldest banks in the UK. Had a great reputation. The auditor that was going to come in, Nick Leeson said, I'm done for her. She's going to find out that I don't have $300 million at Citibank, that's all a lie. She walks in the door. He's like, okay, this is it. Time to confess. While she's walking in the door, she gets a call. I don't know if it's on the cell phone or not, because I don't know if they had cell phones there. And she got a call. They called her back to London, and her understudy took over the audit. Her understudy thought that Gleason was the greatest investor in the world. And he was just like, oh, you're so great. He did nothing that he's supposed to do. Auditors are pretty important. They're supposed to find these things. They should have seen that he was violating policies, that he was buying bonds that really did not belong in his portfolio. It was KPMG, pretty impressive firm. They're still around, right? It's not Arthur Andersen. Arthur Andersen was Enron. Who is Arthur Andersen today? Anybody know? Where do all those people go?
I mean, it was just the name, right? The name of the company, Arthur Anderson.
Yeah, so where do all their people go?
Some went to jail.
Accenture. No, the Accenture is now Arthur Andersen. I don't know if y'all ever heard of that firm. An IT consulting firm is really quite good. At USAA, we had, oh, you go in one section, there'd be 50 Arthur Andersen people sitting in there, and you wouldn't have known they weren't USAA employees. They essentially outsourced. So these are big firms. They're pretty impressive, but for some reason, KPMG did not see the obvious that they should have. Auditing firms do make some pretty serious mistakes. Standard & Poor's gave them a AA rating. So again, think about it. You're an investor. This is a AA rated firm. You got to put a bond in your California mutual fund. It's got to be a muni. Orange County is one of the biggest, and it's AA rated, and the person managing it has this huge reputation for you. Wonderful. Seems like a no-brainer to buy this bond. All right, so we'll see from John Bonnell's standpoint. In fact, S&P and Moody's, they actually told other cities that they'd only affirm their ratings if they invested with Citron. That's how clueless they were. So how clueless are rating agencies? Yeah, they make some pretty serious mistakes as well. They tend to be really good at managing the risk that last hit. So when real estate blows up in the 80s, they get really interested in real estate. When junk bonds blow up, they get really interested in junk bonds. They tend to be a little bit behind. Not that they are very smart people, but they have I think they have too many companies that they're following. They really are just too busy. So they make mistakes. They mess up. Obviously, they messed up in 2008 in rating those subprime mortgage-backed securities, and so they can make some mistakes. Should they have caught what's going on? So I told you the story at USAA where, you know, I was bold. Let's sell all our mortgage-backed securities. I thought it was a terrible investment. Standard & Poor's and Moody's started downgrading companies with mortgage-backed securities. So they saw that one before it started to hit. We were real lucky we gotten out of them. Sometimes it's after the fact. Sometimes it's before the fact. You know, you have to go back and look at the history. One thing you notice in that credit analysis you're going to do for the final, that the default rates by ratings are pretty consistent. AAA bonds rarely default. BBB default about 5% of the time. So they have a pretty solid history, but in 2008, they weren't rating corporate bonds. They were rating asset-backed securities. That's where they messed up. So here, did they mess up? I don't know. Again, we don't have the insight, but this is what we're missing, is a fly on the wall during their discussions internally to S&P and Moody's. That would be wonderful if we had that. If we had the inside discussions with KPMG. You know, that's part of the problem with auditors, is they have their list of stuff to do. And if it's not on the list, there's, again, so overworked. Have you ever talked to an auditor in February, March? They don't want to talk to you, do you? Or January, February, they're just so busy. I remember when I started USA, I was learning the life insurance side, and I was learning as fast as I could. I had the same auditor, and the first year he came with his papers, I filled in all the numbers. The next year he came with his papers, he knew nothing more about USAA than his first year. He never asked questions. He didn't ask what the numbers meant. He was just And so I've told people, if you're going to work as an auditor, yeah, you got 4 hours of overtime. You better have 6 hours of overtime. You better be asking questions about what you're doing, because if you're just filling in the work papers, you're not learning anything. That guy learned 2 years as auditing a life insurance company. He knew nothing about life insurance companies, and it's not his fault. It's the nature of the work. So I think there is something with that going on with auditors and rating agencies. They tend to have their list, their process, and they tend to miss the obvious because it's not on that list. So I'm not saying that's what happened. I don't have the inside scoop, but I've seen that before. That's quite a bit of oversight. You've got supervisors who should be asking Citron, what's your strategy? What are you doing? How did you do so well the last few years? You should have the auditor saying, why are you buying these bonds? That's not in your policy. You should have the rating agencies, especially, they should be the most sophisticated, completely missing it. You can see why John Bonell probably should have bought this bond. My word, how could all these groups miss anything obvious? Obviously, this is a safe bond. It's AA rated. And then somewhat related to that is no clear lines of responsibility. There was a board that felt like they can't tell an elected official what to do, just no accountability. They were somewhat rubber stamping. I asked that question with your banks. How much is the board really asking questions? I thought it was interesting at USAA when Bob Davis came along. Before Bob Davis, I felt like USA's board was somewhat rubber stamped. I can't say for sure, but I know, especially with General McDermott, it was like, I'm running this company. When Bob Davis came around, he said, you're my board. You're going to do your job. You're going to study. You're going to ask questions. You're going to be involved. I don't know why he did that, but that's what he did. He wanted the board fully involved in USA's decisions. He essentially put that pressure on himself to be able to answer to the board. And he went to them and said, this is what we're doing. But Citron, no. Board, leave me alone. Don't tell me what to do. Don't question me. I'm the expert here. Also, what happened in California, there's some of this is just happens, things happen that cause risk. And so Proposition 13 came along at that time. Californians said, you know what? We don't like taxes. That sounds strange today with California, but at that point, we don't like taxes. And so tax rates were coming down. California has this thing where you have all these propositions, you go around, get signatures, you get it on the election. And so you have these things elected. And so Orange County is seeing its tax revenues drop. And they go to the bond manager and they say, can you get us more income? This is a question, if you interview with the bond manager, well, first of all, if any of y'all work in, so like Victory Capital does bond investing, there's one thing you need to know, DC cuts I, and none of y'all know that because none of y'all have had my bond class, my investment class. Some of you are going to take it. Wow, you're going to take me again. That's, well, you want pain and suffering here. But what is DC cuts I? If you know DC cuts I, you know everything you need for a bond investment. What does the D stand for? We've talked about it in this class. Duration. What's the C stand for? Credit. That's the second C. That's the third. That's the second C. What's the second letter? The first C. What else I'll talk about related to duration? Duration and convexity. Duration, convexity, credit. The U, where do we live? United States. You can do U.S. bonds or non-U.S. bonds. What are we talking about with the municipals? The T, not for Texas. T for taxes. Is it tax exempt or not? Municipals. The S and I you'll never get, but we did talk about I. It's one of our risks. What was one of our risks that starts with an I? No, interest rate risk is the D and the C. Inflation. And then what is the S? Y'all never get the S. I did mention it, but S is structure. So duration. Duration is the direction of interest rates. What was Orange County betting on? Interest rates falling. He was taking a duration bet. Convexity is a bet on the volatility of interest rates. C is a bet on credit. If you're expecting a recession, do you want to be high quality or low quality? It's not a fake question. It's pretty easy. High quality. If you're expecting a great recovery, you want high quality or low quality? 2009, you want to be buying high yield bonds. 2008, you wanted to be shorting high yield bonds. All right, US versus non-US. Most people don't do that one because currency risk overwhelms everything. So I tend to think of non-US as kind of an alternative asset class. T, you look at your tax rate, you figure out should you have municipals or not. It kind of depends on your tax rate, and you look at the yield on municipals. Structure, there's a lot of structured debt. If you read Fabozzi's handbook on fixed income, it's over 1,000 pages. Probably 400 of those pages is on structured debt. Asset-backed securities, mortgage-backed securities, structured debt. It's a big part of finance. Commercial mortgage-backed securities. If you go to Victory Capital and get to meet with Trey, Trey is an absolute expert on commercial mortgage-backed securities. He knows them backwards and forwards. Your entire career could be on one subcomponent of the S. And in inflation, we do now have inflation-linked bonds, TIPS. So we do have something for inflation. But DC cuts out. Can anybody say them again? Duration, convexity, credit, taxes, inflation. If you know that, you can talk. What's the other thing you should know on bonds? When you ask a bond investor for yield, you are asking him or her to take on more DCC risk. How do you get more yield in a bond portfolio? You go out on maturity, you sell convexity, or you take more credit risk. When you go to Robert Citron and see, we need more yield, what are you telling Robert Citron? Take more risk. I saw this at USAA in 2007. Poor John. I should have John come talk. The other John. I don't know all these Johns. John Spear, he ran USA's life insurance portfolio. In 2007, they said, John, you got to give us more yield. It's like, well, I think I'm doing a pretty good job. I'm giving you good yield. And they say, no, give us more yield. He says, well, I can take more risk. Yeah, take more risk. Okay, you want me to take more risk? I can do that. You sure? Yeah, take more risk. And then 2008 happens. It blows up and like, John, why did you do that? You idiot. We can't believe you took all that extra risk. And yeah, I did exactly what you told me to do. I used to tell people, you see John in the hall, give him a hug, because that was a horrible year for him. His portfolio fell 15%. His net worth of the company went negative. His bonds fell further than the net worth of the life insurance company. They were essentially insolvent. Poor guy. I mean, it was terrible. He had so much pressure on him. It was really, really quite horrible. He is a great investor. I love him as a public speaker because he's, first of all, really funny, but he's also brutally honest, which I love. John never falsely complimented me ever. He and Donna, I love working with those two because they were like, Donna would give me the, you got to be kidding me, Rod. Look, I loved it. I mean, it's great. You just knew where you stood. So just know this, if you're interviewing with a bond investor, DC Cuts Eye is going to tell you what are those things you can do with the bond portfolio. But if someone's asking for more yield, you can say, where do you want me to take the risk? I can go out on the yield curve. I can get a little more return if I go out 7 years versus 5 years. But if interest rates rise, I can sell convexity. I can buy callable bonds. I can buy mortgage-backed securities. But if interest rates get volatile, that's going to blow up on me. I can buy double B bonds instead of triple B bonds. But if we go into recession, that's going to, which poison do you want me to take? Essentially what they're telling John is get us more yield, but don't take more risk. And John's going to say, that's my job. I'm already doing that. I'm doing it the best I can. So you're essentially accusing me of not working hard enough. And I am working really hard. I'm getting you the best yield I can for the risk we're willing to take. So it's almost an insult. If you tell a bond manager, get me more yield, but don't take more risk, you're really insulting the poor person. Okay. It's like going to a stock investor and say, hey, can you buy better stocks than you are right now? Like, yeah, I guess I could. Or why don't you just hire another person? All right. So pressure for yield. He was pressure for yield. He decided to take more duration risk, go out on the yield curve. Why? Because if interest rates fall, that's going to really benefit him a lot. And he'll win. He'll win both on getting higher yield, plus he'll get price appreciation. And then his arrogance. Arrogance probably based more on luck than on skill. So his prior bets had worked really, really well. His record won him a dangerous degree of freedom, allowed him to do stuff. He was pretty heated and viciously responsive to criticism. That's definitely not the boss you want. If you have one of these type of bosses, I would switch jobs really fast. So your most important boss is your first one. Your first boss is more important than your first company. You need that person that's scary to death, but is a teacher. So my first boss's boss, he scared me to death, but he was a professor. I love talking to him. He had this paper he wrote on how to analyze leases. I read it. I thought it was great. I started doing it. He was so proud I was using his paper. And I was kind of, smoozing there a little bit, but it was really good. It was a really good paper. How do you analyze a lease? And his paper explained it so perfectly. And USAA was doing a lot of leases there, and I did it. And he was like, "This is great." I got some brownie points from him, but I went and said, "I think this is how I interpret your paper. I think I got it right." I showed it to him. He had some feedback, but he was a scary guy. He was scary because he was so smart. He was also extremely type A personality. But that was good for me, right? It's good for you to get that kind of fear. But he didn't mistreat me. He didn't call me an idiot. He was pretty harsh, but he wasn't that bad. And he wasn't heated and vicious because he was scared he was going to be found out. And that's the kind of boss you don't want. A boss that doesn't want questions because he or she's worried you know more than they do. That's not good. So your boss should scare you to death because they really and truly are that much more knowledgeable than you are. I think Citron was probably like that because he didn't have the college background. He was probably a little defensive. He didn't want to be challenged on those kind of details. If you'd ask him what's the duration of your portfolio, he would not have known what you're talking about. If you told him, why don't we run a value at risk on this portfolio, he would not have known what you were talking about. So you would have been really out of his league. He bragged at the board because he did have a great record. I think most of us would do that. That's, if you have a good record, you're going to brag about it. Um, so you do that. The board should be asking, why were you successful? And why do you think you're going to still be successful going forward? We've just gone through a period of time where interest rates had done nothing but fall. How would your portfolio have done in the late 60s going into the 70s? What if we ever repeated that? Those are kind of obvious questions the board should have asked. These are not the kind of words you want to hear from your boss. Prickly, secretive, controlling, decisive, and arrogant. I mean, decisive is good. But if you're working for this person and they're decisive, but you don't know why they're making those decisions, that's of zero value to you. You need to sit down and say, okay, why did you decide to do this? What if this happens? And if the person's real defensive, that's just not going to be good. So there's nothing worse than a gambler. This comes out of the article. There's nothing worse, I think out of the book. I think I actually read the book and summarized. There's nothing worse than a gambler who goes to Vegas and then wins. They have their trick. They understand it. That may be true with blackjack. There may be some trick on blackjack if you can count cards. I don't know about on a roulette wheel if there's any secret. There's any way to beat the roulette wheel. Any secret that you can come up with. You sit there and watch it. Maybe there's a little bit of groove somewhere. I don't know. Then in late 1993, he asked, why do you think interest rate? Now, if interest rates just stayed low, he'd still win because you're going out on the yield curve. You got on the yield curve, you get the higher yields. You're okay if rates just stay flat because you still get that higher yield. Your only risk if rates rise. So your best case, you go out and you get that higher yield and rates fall. Then you get price appreciation in the higher yield. You're okay if rates stay the same. Your only risk if its rates rise. So why do you think rates are not going to rise? He says, I'm one of the largest investors in America. I know these things. Do these two sentences go together? Did y'all take logic? I highly recommend you take logic in college. Anybody here take logic? Any of y'all taken logic? I took it at UT Austin because I needed an elective. Y'all had geometry in high school, right? Did you like geometry? You like geometry, you like logic. Every finance major should take logic. So what is logic? It's premise. What's a valid argument? If all the premises are true, what has to be true? The conclusion has to be true. That's a valid argument. And that's what you do in logic. You make sure it's a valid argument. So you actually, just like you did in geometry, if A equals B, blah, blah, I can't do geometry anymore. Could y'all do geometry? I gave it to you, you still could. You can remember how to do it. I can't remember all those proofs we did. I love that. It was really, really great. That's why I loved logic. I took a couple of classes on logic. Boy, I love that class. But that's what finance is. Finance isn't premise, 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 but it's assumption, assumption, assumption in theory. And so you have to make sure it's actually valid. This argument is largest investors know everything. I'm one of the largest investors, therefore I know these things. I mean, it's a valid argument, but what do you do if, and this is what I hate about politics, if you have a valid argument, what do you do? If all the premises are true, the conclusion has to be true. Do you debate the conclusion? No, because if the premises are true, the conclusion is true. What do you do if it's a valid argument? You debate one of the premises. All you got to do is prove one of the premises is false. What do politicians do? They debate conclusions. It's an incredible waste of time. So what I do when I listen to politicians, because I hate politics, I did this with President Obama, I did it with Clinton, I did it with Bush. As I hear them speaking, I reword what they're saying into a valid argument. And when you do that, you start discovering that politicians have some big gaps because some of the premises you have to put in are like, I'm a genius. Everything I say is right. You're like, okay, that premise may not be true. You kind of jump like we're missing a really important premise here. And it really helps you. That's why I love that class. If you can get into that logic as a finance person, so that you force yourself to say, okay, exactly why am I making the decision? Here are my assumptions. Here's my premises. If this is all true, then this is the right decision. Which of these premises do I need to really beat up on? You're going to do a whole lot better. Instead, we debate conclusions. This is a really, really bad argument, and you should really challenge him on that. What is the fact that you're large has to do anything? That you're Orange County, you're large because it's Orange County, not because you're a great investor. So you can certainly challenge him, but you see his arrogance there.
That reminds me whenever like JP Morgan says like we're so big that we can't fail.
Yeah, well, look at his premises. Is he saying they're big because they're really, really good, or they can't fail because they're so big they'd have to get bailed out? Yeah, you have to look at it, but see if you can go back and see what else they said around that and actually construct a valid argument. And if you come up with one premise that is so ridiculous, you kind of laugh and say, okay, yeah, it's all smoke and mirrors. Try that with politicians. It's really pretty incredible. Listen to some of these debates. It's almost comical if you think in that line. It's like this class really messed me up for listening to politicians because, like, man, you're missing like 6 premises. For a lot of politicians, is everything I say is right, true. This is true, therefore this is true. I mean, that's their entire argument. So it's like, yeah, you need a few more arguments than that. All right, the next thing was he didn't take this class. He didn't take Catapackham's class, didn't take Principles of Investments. Where he messed up on his skills, he was missing some really basic stuff. There's stuff in this class that's pretty basic, but the majority of people in the world don't know it. So you have skills. That's what I always ask finance majors when you graduate. What do you know that the person on the street doesn't know that you can actually do something valuable? Diet, risk, duration, convexity, those are the kind of things that give you incredible power on the investment side. I love reading Roger Ibbotson. He understood duration in the 70s before anybody else did. He said it was like fishing in a barrel. It was a piece of cake because he understood. You know stuff that the average investor doesn't know, or do you? That's the question, right? As a finance major, what do you know off the top of your head? That's a great skill. Do plumbers have skills that the average person doesn't have, that they can walk in and do stuff? They're pretty confident. So you as a finance major, what do you know off the top of your head when a problem comes to you? So walking in with Citron, if I'd walk in with Citron, okay, you're a money market account. What's the duration of your portfolio? Oh, I don't know. Well, let's sit down and calculate it. All right, the duration of your portfolio is 7.5 years. That seems like you're really betting on rates falling. Yeah, rates are going to fall. Why do you think rates are going to fall? What's your premise there? Why don't we run a value at risk? What's that? So you know stuff. It's pretty impressive, right? This is a guy in the front page of Business Week, one of the most impressive investors in the United States. You walk in there and you can do his job. Just coming out of this class. That's pretty exciting, isn't it? You know stuff. That's pretty powerful. So his annual reports, the boards are rambling, incoherent. CMRA, y'all remember them? They're the firm that steps in after the fact and picks up all the pieces. What Leslie Rawls said was, we're surprised that for a portfolio of that size and with its reputation, how unsophisticated this person was. This is one thing it has been so amazing to me. You assume firms like NVIDIA, Microsoft, JP Morgan, like to your point, JP Morgan, Walmart, you assume these firms are just practically perfect. They do everything right. There's no problems. And when I walked into USA, had that reputation, you slowly start saying, you know what, we're pretty sloppy over here. We could add some value here. And I think in every firm, even in NVIDIA, you think, wow, they got it really, really down. I think every firm, we were just at Valero, very, very impressive firm. They know what they're doing. But there are areas where you could walk in and say, well, you know what, I think I could add some value here. When I talk to people at JP Morgan or Citibank, get the inside scoop, they admit these are not perfect firms. They have some struggles. So Citron might be an extreme case, but every firm has something going on where it's just like not paying attention, where too much is doing it by habit. So Citron, he said some things that you coming out of this class should have made you really concerned. So he said, all investment managers have planned for changing in interest rates. What was his plan for changes in interest rates? He assumed they would fall. That was his plan. As far as interest rates falling, or yeah, anything in this summary is fine. Yeah, and y'all know how picky I am on details. So any detail you put in there, yeah, I mean it does give you somewhat of a sight. You don't have to quote him word for word. You could paraphrase it, but you certainly see that his confidence is probably a problem. I never had the confidence I do now because I'm out of it, so I don't have to worry. But I was always scared to death because I just came in just thinking, man, I don't know if I can do this. And then we started the USA investment group where those people were we were harsh on each other. So that's kind of back to, Annie Duke's decision pod. I think I was real lucky to be surrounded by people like John Manel who would tell me like, Ron, man, what have you been drinking? Citron didn't have that person. How would you think you would have done if you'd walked in as his intern? You think he would have gotten anything done? How would he have reacted? You probably wouldn't have lasted very long. That's why you can't stay at a firm like this very long. It's just not going to help your career. So he said something I don't agree with. He says you can't make plans for a worst case scenario. Why not? There's value at risk. He didn't know what value at risk is. Why can't you make plans for a worst case scenario? We were just talking about that at Valero. Some of the students are recommending energy stocks. They say, well, what if Iran gets resolved and energy prices fall? I say, well, we're neutral on energy stocks. So if energy stocks are 5% of the index, we're 5%. So that's not the issue. The issue is, what is your energy stocks beta to the energy industry? If it's 1.2, then we're going to benefit if oil prices go up. We're going to be hurt if they fall. If your beta is 0.8, then if Iran gets resolved, it'll fall, but not fall as much as the other. So that's kind of your worst case. We're in energy stocks. So the question is, how will this stock perform on the upside versus the downside? So you have to set up the scenario correctly. But Citron, we're looking at a case where interest rates were 18%, now they're 5%. Does it really make sense to keep thinking they're going to keep falling? It may make sense they're going to flatten out. Maybe that makes some sense. The U.S. 10-year Treasury, last time I looked, it's been a while, but spent 50% of its time at 4.5% or higher, and 50% of the time it's 4.5% or lower. So it's getting pretty close to its median, historical median. What question would you have asked him? What would you have said to him if you were in committee and he said this? I would ask, why not? What would hurt for us to at least look at the worst case scenario? So he's saying you can't make plans, but he didn't even look at it. Why don't we look at it? What if interest rates do shoot back up to 8-9%? He says you can't do that because if you make plans for worst case scenario, you give up opportunities to make good returns. Well, you probably say, we can't just move the cash, and your answer to that be, but that's what we're supposed to be doing. That's what this portfolio is. So yeah, we can just move the cash. That's our job. As money managers, it's our job to assess the most likely interest rate risk and make plans. That's true. I agree with that. But it doesn't mean you bet the entire farm on that scenario, because you could be wrong. He says, I can't discuss the specifics of my contingency plans. Why couldn't he do that? Because he didn't have any. Or at least that's what the news reports were. Because if we did, other people would know what we're doing, and that would give me, well, the board of supervisors can certainly discuss his plans, and they should be discussing his plans. So how do you do this in your first job? You ask those obvious questions, and you don't do it in a way that they're like, man, you're questioning us, that we don't, you always, you start every sentence with, I really want to learn this job and learn what y'all do. So can I ask some basic questions? You start off just admitting they're smarter than you, right? I've had some entry-level people like want to teach me CAPM. It's like, yeah, I've had that. You don't go in as a teacher in your first job. You may know something they don't know, but you don't do that. You start off with, okay, Citron, wow, that's interesting. Well, I really want to, you're so famous, you smooze them. You obviously know what you're doing. You're really good at this. I'm just curious, what happens if interest rates go up? And just see, you can ask those kind of questions. What happens if oil prices do hit 150 or 200 bucks? What happens if the Fed actually starts raising rates instead of cutting rates? But you set it up and that you want to learn. If you do it like that, you can probably get away with quite a bit with a good boss, and then you get crushed by a bad boss, which is good. Is it bad to get fired by a bad boss? Probably not. They're probably doing you a favor. So, ask those questions, and you should be asking those questions, find reasons to do it. So his contingency plan was to bet on rates falling. He said, I'll just hold them to maturity. Yeah, I mean, that's true. You hold it to maturity, eventually come back to par, but you're going to have some huge losses on the way and be giving up some good income opportunities. The next thing he did was he did some stuff that was really out of his league, and he was the first to do it. So he got state laws to change so he could get into these new type of investments. And then he bragged about getting the law changed so he could do these things. The problem lies not in the investments, but in how he used them in an uninformed way. So he created an inverse floater. There's a whole chapter on inverse floaters. So anybody know what an inverse floater is? You know what a floater is. A floater is just a variable rate bond. When interest rates rise, it goes up. When interest rates fall, it go down. So what he created was an inverse floater. It pays a fixed rate minus a floating rate. So maybe it pays you 8% minus SOFR. If SOFR is 2%, you're going to make 6. If SOFR falls to 1%, you make 7. So what's your risk there? What happens when rates rise? You're in a lot of trouble, right? So he's doing inverse floaters. Inverse floaters do what to your duration? If you have a floater, what's the duration of a floater? It's just going to change it. It's going to change your income every time interest rates move up. It's got a duration of 0, right? Because it's completely reflects interest rates. What's an inverse floater going to do? It's going to crash when interest rates rise. It has very high duration. He was adding tremendous duration to his portfolio with these inverse floaters. Used to be LIBOR at the time. Now it's SOFR. In fact, John Monell might accidentally say LIBOR, but it would have been correct because he's talking about Orange County here. So it might pay you 8% minus LIBOR. If you really think rates are going to fall, it's a great investment. It's like a really quick way to take advantage of that particular security. This sounds like, what else does this sound like? What did we talk about on balance sheet immunization? Doesn't that sound like an interest rate swap? I'll pay you 7%, you pay me SOFR. It's very much like you could probably replicate an inverse floater with an interest rate swap. It probably wouldn't be that difficult. Very, very, very similar. So if you're getting paid fixed and you're paying floating, it'd be very, very similar to what's going on here. Obviously, betting on the recent past, interest has been falling. Let's assume they keep falling. That works really well until it doesn't. using leverage. So when you looked at the maturity of the portfolio, it didn't look like it was, the maturity, like on these inverse floaters, the maturity may be 1.5, 2 years. Doesn't look all that bad. But an inverse floater is creating leverage, just like an interest rate swap creates leverage. I was talking to Brennan early. You can have an interest rate swap that's only 2 years to maturity, but the underlining is a 30-year zero treasury. It's 30 years duration. The swap itself may have a maturity of 2 years. So people are looking and say, well, your maturity is only 1.4 years. That's a little long for a money market account. Money market should be 3 to 6 months. Doesn't look bad, but the effective duration was 7 years. He was using repos, inverse floaters. We're not going to get into repos. I think John Bennell is going to talk about repos. I'm not good at repos because I was never on the bond side. I find them really interview experts in repos. Really complicated. But anyway, I mean, he was getting the stuff out of his league. Merrill Lynch actually sent a letter to Citron telling him, you're a little bit out of your league. You're taking some risk you shouldn't take. And Citron's like, no, leave me alone. I know what I'm doing. And Merrill Lynch did that even though they were making a fortune off of Citron. They loved this guy. They were selling him all kinds of stuff, making all kinds of fees. And even they said, we like making all this money off of you, but this is going to blow up. And he kept doing it. He focused on one risk, which was credit risk. He was really good at managing credit risk. He had an incredibly high quality bond portfolio, AAA bond portfolio. So what risk was he taking? He was taking interest rate risk and doing it in a way that was somewhat hidden because he didn't calculate duration. You could have calculated duration in this portfolio. You could have run a value at risk on this portfolio. You would have seen very quickly this portfolio is going to lose a lot of money if interest rates rise. He was also doing some liquidity risk because some of these strategies he had were very similar to MG, where he was, had cash calls. It was really interesting at Valero. They were talking about a firm that had some oil contracts that they were hedging with futures. And they had cash calls where they had to borrow money and it caused problems. That sounds exactly like MG. I was like, wow, this is like MG. This is a different case. So it's almost like MG happened again. You kind of have this here where he's getting cash calls and it was something he really wasn't prepared for. And he had to find the cash somewhere, somewhat of a run on the bank. So he had really highly correlated risk. Interest rate risk really was the biggest one, but in a somewhat concentrated way. Part of his liquidity risk was he was doing these new securities, these inverse floaters. If you got a brand new security that hardly anyone else is buying and they start blowing up and you're picking up the phone and you got to sell these things, you're probably not going to get too many buyers. It's like, hey, these things have been out there 2 years. They worked really well the first year, but they're blowing up now. Would you like to buy some of these? Like, no, my boss probably doesn't want me buying what's currently blowing up. He assumed the market would come back, so he liked using the term paper losses. I got that from the fixed income people at UTSA. This was a big debate we had. I wanted to calculate the total return on our bond portfolio. They didn't. This was an older generation, the generation my age. They all were kind of on my side of it. But he said, we don't need to calculate the return on bond portfolio because we're going to hold everything to maturity. If you buy it and it falls 10%, when it gets to maturity, it's going to be back at $1,000. So you bought it at 1,000, it falls to 900. When it matures at 1,000, what do we care about total return? My argument was, yeah, you're going to hold it to maturity if it doesn't default. But if your bond portfolio falls 20%, wouldn't you want to know it's falling 20% and ask why the bond market hates your portfolio so much? Wouldn't that be an interesting question to ask? Is it because of the credit risk you're taking? Is it because of sectors that you're in? Is it because of the interest rate risk you're taking? Can't we at least just ask the question? It wasn't long after that we started doing total returns on the portfolio, and it was pretty interesting. And the people who took their place, like John Spear, he wanted a total return. He understood that that was a great early warning system for him on his portfolio, because that's essentially the most sophisticated people in the bond market telling you what they think of your bond portfolio. You want that kind of feedback. It's exactly what you want. But Citron said, no, these are paper losses. You buy a stock for $500. I was looking at Avis today. Have y'all see Avis stock today? Anybody? What in the world is going on? What did I do? So how much, anybody want to guess how much Avis stock is down today? Its ticker is CAR. Any guesses? 5%, 10%? It was a $500 stock. Where do you think it is today? It's not a $500 stock today, is it? If you bought Avis for 450 bucks, you're gonna tell people, oh, it's just a paper loss. Don't worry, paper loss. Does that look like a paper loss? Now, if you go back a few days, looks a little different. It went from $100 to $700, $200. You're going to buy Avis and just say, hey, paper losses. Or do you want to know that the market's doing this? Would this be important insight on your portfolio? Might be important insight. I don't know why it's doing that. There's some hedge fund doing something weird. I don't own Avis. I didn't short Avis either. Same thing happened with GameStop, right? Which is pretty amazing, 20 bucks, and suddenly it's a $400 stock. So total return actually is extremely important for bond portfolios. Don't let anybody tell you, don't worry about bond returns. I'm holding at maturity. That just is not the right answer. So what did Citron do when interest rates rose? Well, the first thing, what a lot of people do in this situation is they double down. We buy more of that stuff. If you double down, it always succeeds 100% of the time. You go to Vegas and you bet 100 bucks and you lose it, then you bet 200 bucks and you lose it, then you bet 400 bucks and you lose it. You will eventually make a lot of money. Bet 800 bucks and lose it, 600 bucks and lose it, 3,200 bucks and lose it. You will eventually make a fortune, unless what? What's the only thing that stops you from making a fortune? Because eventually you're going to win, right? What's the only thing that's going to, you run out of money. Doubling down always wins unless you run out of money. So he doubled down, right? Let's double down. And doubling down would have won, wouldn't it? Because what happened? Right back. So it would have won, but could you keep doubling down? At what point in here do you say, you know what, I think I messed up? So, here you double down. See how smart I am. Oh, well, maybe not. Oh, well, I'll double down here. Finally, here it comes. Oh, wait, maybe not. It's really hard. When you're looking at that, it looks so obvious, doesn't it? But when you're sitting right here and it's doing that, don't you feel pretty confident? It seems like this looks like the right shape, doesn't it? And yet it didn't. It did that. Is it so obvious you're at the top here? It's obvious now. But when you're sitting right there, what are you doing? I give up. Let's shut it all down. Let's go back to cash. And what are you thinking right here? Well, whoops, we should have stayed where we were. It's really tough. Your job is really, really, really tough. And so he doubled down at the worst possible time. And then just bad measure. And really important to this case is value at risk. You have to talk about duration and value at risk in this case. Why? Because I want you to go out of this class knowing the basics work. Don't go out of this class. Well, they teach us undergraduate stuff no one uses anymore. No, we still use this stuff. Y'all know I didn't like value risk, but value risk is really useful here. Gives you great insight that, wow, we're really rolling the dice on interest rates here. This is really dangerous. Value risk gives you great, great, great insight, especially here. It really would have been, all you do is just go back, get historical interest rates, run against this portfolio and say, man, we're going to lose quite a bit. So no value at risk. He didn't know such things existed. He said you're not required to report losses. So yeah, just the really, really important part of this case. But all of this is really important. It gives you quite a bit to talk about. So interest rates rose sharply. And what's interesting, his portfolio lost $1.5 billion. Almost exactly what the duration would have told you. So forget convexity. That minus duration times some change in yields, that 200 basis points increase in interest rates is exactly, so almost duration, you could have almost not even done bite risk. So what do you call it when you look at 100 basis points, 200 basis points, 3 basis points? You could have just done what? Stress test. You could have said, hey, Citron, if interest rates rise 200 basis points, we're going to lose 15, 20%. And what would he say? Oh, they won't do that. How do you know? Oh, they won't do that. Why do he say I'm the biggest and one of the best investors in America? I know these things. Yeah, how do you know these things? So anybody want to work for Citron? Get out as fast as you can. You see why your first boss is so critical. Everybody's like, oh, I want to work for JP Morgan, I want to work for USA, Valero, those are all great companies. No, you want to work for a genius. That scares you to death, but also is a teacher at heart. One of the things you have to accept is just being stupid, being ignorant. That's just the nature of a first job. Just accept it. You walk into that job and it's like, man, I'm the only person around that knows nothing. I know absolutely nothing. Just accept it. It's painful, but it does not last long. 3 months, 4 months later, it's amazing because you're sitting there 50 hours a week. It is amazing how quickly, but only if you're asking questions. If you're sitting there like, man, I don't want them to know how stupid I am. You're not going to learn anything. A couple of things. First of all, you're not stupid, so you will learn it. Second law, if you are stupid, you need to change careers. And when do you want to learn that? As early as possible or as late as possible? All right. So if you really are incapable of the job, ask a lot of questions so you find that out as early as possible. If I had gone and worked for utility, I would have found out very quickly that I was not made for that. When I was analyzing utility bonds, I didn't know what a watt was, and I could not figure out what a watt was. I didn't understand how to do the math on the watts, megawatts, tera, whatever. It's like, I don't understand. Utilities are so complicated. I would have been a failure in that industry. I was so lucky it was banking and insurance. For some reason, my mind, did I know that in college? Was I sitting my senior year in college? Man, I need to do balance sheet immunization. I mean, that's just where I'm built for it. But you got to figure it out as early as possible. So you don't want a Citron, but you do want someone who is going to scare you to death so that you can find that out as early as possible and then start asking those questions. Be willing to just be put to shame by how can you not know that? All right, so there's the second one you can do. Make sure you have a pretty good summary here. Make sure you have those obvious things in there. So Tuesday, if you really want to do Orange County, ask some good questions for John Bonnell. He's going to give you some really, really good insights there. All right, I'll stop it there.